Good afternoon, everybody. Welcome back to the Opportunistic Trader. We're joined now by Dave Floyd of Aspen Trading. Dave joined us last week and really went through some pretty interesting charts, the way he looks at technical analysis, the currency markets, and had some really interesting insight. We're actually having a little bit of technical difficulty. You're gonna hear him perfectly, but he can't hear me, so I'm gonna be texting him questions. So if there are any questions, please text. But Dave, welcome, and take it from there.
Great. Thanks a lot, Mike. I really do appreciate it. And welcome and good morning to everybody following along today. We've, as Mike had said, my prime focus, at least over the years, has been on the FX markets. But if you're trading FX, you really have to be looking at all of the major asset classes. So I've slowly evolved into primarily FX, into basically a multi-asset class trader, S&Ps, 10-year notes, major FX pairs, and of course some select stocks. But what we're seeing in a day like today, where we're basically flirting with all-time highs, is we're getting a lot of back and forth, a very, very choppy price action. The chart I wanted to share with you first is right now I have it set as an hourly chart of the S&Ps. And as you can see, from about September 20th, September 21st, we've been in a pretty narrow range, 29.05 up to 29.50. And that's pretty much been how we've been trading. I have it labeled, at least as a correction, as wave 4 being completed back in here. And that may or may not be correct. It's a question of whether or not, from an Elliott wave perspective, you can start counting some of these as 5-wave moves. And, it depends. I mean, you have to use a little bit of, what's the word I'm looking for? A little bit of discretion. But I think the bottom line is, at least, even if you don't approach the market from an Elliott wave perspective, the market is poised to go higher. Let me at least pull a 4-hour chart up to give you a little bit better perspective. And again, if we could just go back to the August lows, the trend is clearly higher. There's no doubt about that. How this move in here is playing out remains to be seen. But absent some sort of an exogenous shock or some really, really bad news on the economy or whatever the case may be, this is simply corrective price action. I don't care if you're an Elliott wave analyst or you're just a basic price action guy or gal. The trend is higher. This is choppy. The odds of us moving significantly lower, in my opinion, pretty low. Doesn't mean it can't happen, but again, trying to put the odds in my favor. So what I do from here is unclear, at least on a short-term basis. And when you have choppy phases in the market like this, what I typically will do is I will default to either a small position in the futures market, or I'll put on some with the intent of holding it longer to allow for the chop and everything to play out so it doesn't impact me on a P&L basis too much. And then when the market begins to offer some clarity in the direction that I thought it was going to go, I'll either add to that trade or just simply sit in it and let the move play out. The alternative way to do it, the one thing I've done, you're not going to see it on this chart, but 2.5 weeks ago, based on my read of the charts, again, thinking that wave 4 has likely completed in here, the trend is higher, we're likely to move higher into the fourth quarter, I combined that with some quantitative analysis that I was looking at. And some of the quantitative analysis I was looking at was suggesting anywhere from a 6 to 8% return higher over the next 3 months in the S&Ps. And that was just based on simple look back periods of what the S&Ps and the Dow have done in similar phases when they've made, a new multi-year high for the first time in 6 months. There were some other measures I was looking at when it made a new high for the first time in 30 days. It looked back over similar periods going back in time, and statistically, it was a very robust signal for about a 6 to 8% return over the next 3 months. So what I did with that information, we were trading at about 290, 288, or I'm looking at the spiders because I did the actual call spread on the spiders. We're probably trading around 280, 28.90 on the S&Ps. So I did a 288, 310 call spread. And it's really simple. 310 represents about a 6 to 8% move higher from 288. I put it out into December 21st because I was looking at 3 months out. So we bought that, I think, for about $7.28, trading around $9.50 today. Therefore, the reason I bring this up is not to say, hey, look at the great trade I have on, but it was a way for me to look at the price action and go, you know what? I'm pretty sure we're going higher at some point, but this is really choppy. I don't necessarily want to be long a lot of S&P contracts in here because the intraday swings can be a little, unnerving. So I put on that call spread. Now, this morning, however, with prices breaking higher and having some overall good economic data, I did get long some futures contracts. And as you can see on the chart here, from an average price of $29.38. I'm willing to hold these for a day or two because I think the market's poised to break higher here. Whether or not we do it in the next hour or the next day or two, that's unclear. But given the way I'm looking at the technicals, we're really trying to get out of this consolidation range, and we're trying to break above the upper limits, and it feels as though the market wants to do that. So I'm okay being long some futures contracts to kind of complement my spider call spread. So I'm just going to pause there for a moment and just kind of remind everybody the best way, and it works best for me too, and it also works best for you watching and listening at work or at home or wherever you happen to be, is to get a level of engagement here. Feel free to ask me any questions. I'm very transparent. I'm happy to share with you what I'm doing and how I'm doing it. There is no secret sauce, secret formulas. It's good old-fashioned experience, technical analysis, and hard work. So I'm more than happy to share anything that I'm talking about here or address any questions you have. So Mike will relay those to me through text since we're having this audio issue. But again, let's make it a really robust dialogue. Feel free to shoot me some questions. Okay, here's the first one, and this is a very basic but really important question. It's like, how do you set up your charts with Elliott waves? Well, it's a good question. The old-fashioned way is any charting platform allows you to put in commentary or labels. Like, for instance, where is it here? I'm using a platform called Motive Wave. But on any platform you go to, you have the ability to put text on your charts. So in the old days, probably going back 10 plus years, you literally had to put the labels on your charts and then drag them and manually place them. And then as price action moved, you'd have to make adjustments where necessary. Very, very tedious process. It was a real pain in the ass. Along came Motive Wave 10 plus years ago. I was probably one of the first, or certainly one of the first early adopters of the platform. And what Motive Wave allows you to do is as follows. If you want to label your chart in an impulsive way, you simply click on the impulsive. It brings over the 5 labels, and then you just simply drag them and drop them as to where you think they should be on the chart. So again, I might not be addressing your root question, but I'm going to the end first and then working backward. So that makes labeling the charts very easy and then adjusting them even easier. But how do you adjust them, or how do you come up with the account in the first place? Well, it's like anything. You got to learn how to use Elliott Wave and learn how to use it in what situations. And that does take some time. I'm not gonna sugarcoat that. But for me, there's a couple of books out there I'd recommend. I'd recommend a book called Dynamic Trading by Robert Miner. That's probably my all-time favorite trading book. And the reason I like it so much is that you could tell it was written by a guy who actually trades, not by some jerk off, showing you charts that he screen captured from 3 years ago saying, well, I bought it here and I sold it here. And I would say that's 99% of the trading books out there. you could tell that this one was written by a guy who trades, because it was written in his thought process. So dynamic trading is one. Then, of course, the classic on Elliott Wave, which is the Elliott Wave Principle by Robert Prechter. So there is obviously, in all honesty, in the Robert Prechter book, you could probably get away with just reading the first 60 pages initially and get yourself up to speed. I don't think you have to read the whole book. Just get the basics down of impulsive waves and corrective waves, and then start labeling them in real time, and you'll start to learn how to use them. But if you do start taking Elliott Wave seriously, I would highly recommend Motive Wave. It just makes labeling the charts easier. I even put together, because I'm very friendly and I've known the owners for a while, I've even put together my own version of the platform that is specific to the way that I do my Elliott Wave analysis, and that's available out there as well. So hopefully that addresses that question. First, you got to learn the basics of Elliott Wave, but then if you're serious about implementing on a day-to-day basis, I would highly recommend that you get something like Motive Wave. It just makes it so much easier. Let's see, I just want to go back and look at my text here that I'm getting from Mike, make sure I'm getting all the questions. Okay, so I set up how to, okay. You mentioned you're using long S&P futures and a call spread. Yeah, the call spread that I'm using is on the spiders, SPY, which is the ETF. I normally don't do options on the futures. I don't know why. There's probably no reason not to. I've just tended to use option strategies on the underlying equities, or in this case, the underlying ETF. I've typically not done options on futures themselves. So, but basically I'm expressing a bullish trade under either scenario. I'm long the S&Ps this morning from an average entry of 29.38, and I'm long the S&Ps by being long the spider call spread, which expires on December 21st. And the legs of that are, I bought the 288 call and I sold the 310 call, and that cost me $7.28 per contract. Last I looked this morning, it was trading around $9.50, $9.60 per contract. So a very solid gain on a percentage basis for sure, but just a solid gain overall. I'm up, over $2.25 per contract. Each contract, of course, is worth 100 shares. Is there any, the other question I got here, is there any correlation assets you consistently use as a filter for short-term positions? It's a great question. As we all know, correlations are always in flux, but there are correlations that tend to be rather sticky. A good one is higher rates typically equals a higher dollar yen, lower rates typically equals a lower dollar yen. That's a pretty tried and true correlation. The other one, of course, is lower bond prices equal higher stock prices. That's a pretty tried and true one. But I'll be honest, and again, it depends on how you define short-term trade. I don't do a lot of short-term trading. Most of my trades last several days to several weeks. So I'm not really usually getting too hung up on correlations. The one thing that I will look at is I will look at when historical correlations start to deviate, and then try to determine which of the two asset classes is the one that's got it correct. And of course, that's a very tough question to answer sometimes. You might be looking at, give you a good example, or an example. I'm not thinking of a recent one off the top of my head, but let's say the dollar index is moving higher, which would of course mean the euro is moving lower. And normally you don't get much of a divergence between the dollar index and the euro. But let's say the dollar index is moving higher, but dollar yen is moving lower. Well, at some point that correlation is going to come back in, meaning the dollar yen, by and large, and of course, dollar yen's a goofy pair, but by and large, the dollar yen will track the dollar index up and down. So oftentimes when that, let's say, starts to diverge, you start to ask yourself, one, why is it diverging? And number two, which one is diverging, quote unquote, incorrectly? So, if that's happening, I might be a little bit hesitant to be trading dollar yen because I'm not really sure. Something's deviated from the norm, so to speak. But I really can't give you an answer in terms of short-term correlations because I don't really play the markets that way anymore. You know, way back when I was more of a day trader and a short-term swing trader, I could probably add a little bit more color, but I just don't trade that way anymore. I like the idea of doing my analysis, plotting my trades, plotting my stop losses, plotting my expected exit points, and then, you know, waiting patiently for that setup to happen and then managing the trade accordingly. I would say between the markets that I trade, which of course are the major FX pairs, primarily Euro, Aussie dollar, Kiwi dollar, dollar yen occasionally. And then of course I trade the S&P futures. I'll trade 10-year note futures, and then I'll trade a basket of underlying stocks that come onto my radar. So I would say between those asset classes that I trade, which is probably less than 10 items overall that I'm looking at, I might only make 8 to 10 trades a month. You know, sometimes 6 to 8, it just depends. And I'm comfortable with that. That's where I want to be. I don't want to be being a keyboard jockey during the day. Although, given that I came up as a short-term trader, was on the floor for a period of time, I will not be opposed. I will be as opportunistic, no pun intended, as the next guy if I see some opportunities during the day. And I do my fair share of that when the situation arises, because I did have many, many years exposure to reading the tape, as they call it. And I'll tell you what, it's an invaluable skill set to have. If you can read the tape, it really allows you to kind of, quote unquote, see what the market might be doing or listen to the market in a more effective manner. Lots of questions here, and I'm really happy about that. This makes it really easy. It gives me a lot of fodder to talk about. Next question here. What are your thoughts on the strong move in U.S. yields? Not a big USD reaction. Thoughts? Well, it is a good question. Again, rates and dollar index are not always correlated, for sure. In fact, I would argue that while rates might go higher, my overall views of the dollar index will be moving lower at some point in the fourth quarter. That hasn't played out yet. We've been kind of whipped around a little bit in FX recently. And when I say whipped around, not from a trading perspective, because I've been very selective and very patient. But we did get short euro last week. We didn't have a very good exit. We only ended up netting a small profit on the trade, but we did catch the move this recent leg higher in the dollar index by being short the euro. Yields, I actually think, are probably capped. I mean, I think 3.25 on the 10-year note is probably where I would start to get a little concerned about 10-year notes moving significantly lower. That may very well happen. I just don't know if it's going to happen in the near term. But given the way the economy is moving right now, higher rates certainly do make sense. What I'm noticing here, though, is I use something called the Composite Index. And again, I'm sure most people in here have heard of it. It's an index that was developed by Connie Brown. She does some really good work from a technical perspective. And what I'm noticing on the 4-hour chart of the 10-year note is that we're getting new price highs, but for a while now, the Composite Index is simply not confirming that. Again, it's not necessarily a timing signal or a timing indicator, but it's telling me that maybe the momentum is starting to wane. So I'm kind of neutral on my answer here. I don't think that higher rates are always an immediate catalyst for a higher dollar index. That sometimes that can be the case, but not always. Going on to the next question, I'm going to get to a few other charts, but really I do appreciate all the questions. Let's see here. Aussie dollar. Yeah, Aussie dollar has been, hold on. Apparently the guy that's asking is bearish, the Aussie dollar. Aussie dollar is probably one of my favorite currencies to trade. I've had really good luck with it over the years. I would say, based on the way I'm looking at the Aussie dollar right in here, clearly being bearish has been the right call. We've been what I had labeled initially was a 5-wave move off of the early September lows. And then I was looking for a modest wave 2 correction because, again, my overall thesis is still that the dollar will move lower. And then, of course, if the dollar index moves higher, the Aussie dollar would move higher. But I think we're at a point right now where we've broken through this trigger level of 72. We're just getting way too deep in terms of a Fibonacci level for this to be considered a wave 2 correction. So this is probably some version of, this was simply a correction to the upside, and the overall downward move is going to continue. So if I was bearish or if I was short the Aussie dollar, I would remain short. I would tighten up stops though, to protect profits. Things never move in a straight line forever. But for right now, it seems as though that being bearish, the Aussie dollar is correct. I don't have a position in it, but if I was looking to do it, I'd probably be looking to sell the next rally. But again, I'm just talking off the top of my head. I'm not intently focused on the Aussie dollar right now, but I think by being bearish, and if you're bearish from higher levels, one, nicely done. And number two, just manage the trade really well. Wave count subjectivity. What's the biggest obstacle I run into? Well, I want to be really clear. The wave count is not always subjective. There are very objective rules with Elliott wave, and if you implement the rules, that's not being subjective. Where people run into a problem is they try to impose their current view on the market into their wave count. So if they're bearish the S&P, they're going to label that. They're going to find a way to label that chart in a bearish mode. I always approach it from the opposite way, or let's say the opposite way. What's the trend? What's the overall outlook economically and from a macro perspective? What does the quantitative data suggest or should be happening in this market? And then use the wave count that fits that. That to me takes out all the subjectivity because I'm looking at very objective economic data. I'm looking at objective quantitative data. I'm looking at objective trend measures, meaning the trend is up or down. That's easy to determine depending on the time frame you're trading. And then I'm adapting the wave count accordingly. That to me eliminates nearly the subjectivity of a wave count. Now, when you're in the trade and then you're updating your count, yes, there are times when you might be being a little too conservative with your wave count or being a little bit too aggressive, meaning you're expecting prices to move higher than they actually will on the current leg. But the bottom line is no indicator out there is perfect. I could ask anybody a similar question about the stochastics that I have on my screen here. Where does the subjectivity get taken out of those? And the answer is there's objective measures on the stochastics, above 80, below 20 at the most simplistic level. But there's also an art form to looking at stochastics or any other technical indicator for that standpoint. So Elliott wave gets pigeonholed unfairly many times by people, that it's too subjective, there's alternate wave counts. But the bottom line is every indicator you use is not going to be always black and white. You just got to figure out if Elliott wave is something you want to use. What I like about Elliott wave is it compartmentalizes what's happening in the market and provides me a framework to know where I'm wrong, and also provides me a framework to know where I might want to start booking profits based on the historical relationships between the wave structure and the Fibonacci wave structure, or the Fibonacci levels within the wave structure. So again, it's a lot to tackle. I've been at Elliott wave analysis probably since 2005, so 13 years, and I'm still learning. So you're not going to learn in a weekend at a cheesy educational conference at the Holiday Inn. But please don't dismiss it either. And a lot of people do that. They dismiss it too early. I know a colleague and friend of mine by the name of Andrew Baptiste. He was the head of technical analysis at Morgan Stanley for many, many years. And of course, being the head of technical analysis at Morgan Stanley meant you were dealing with institutional clients, the big boys and the big gals. His only approach was Elliott wave, and he was very effective at his job. In fact, he's still very effective. He's since left Morgan Stanley. I still get access to his work, and he does great work. It's very objective, and he's right more than he's wrong. That's all I can basically say. So don't dismiss Elliott Wave. It is effective. So let's take a look at a couple of other things while we're in here. I've got a couple more minutes before I need to run here. But basically, in terms of the dollar index, this is how I'm viewing it right now. Overall, I am expecting prices to probably move lower at some point, but for the near term, I do see some upside towards the 96 level. So that gives us a little bit more room to run. The way I've labeled it at this point is that the move lower from mid-August, that was wave one. This is a relatively, well, I shouldn't say complex, but this is an expanded flat correction, and then we would begin to move lower. Again, that's how I'm seeing it. That doesn't mean I'm wed to this forecast, but this is what I'm keeping in the back of my mind. And again, looking at the composite RSI, new high, new high, new high, new low, not new low, but lower high, lower high, lower high. So this feeds into my overall philosophy that based on the wave count and based on doing Elliott wave and Fibonacci projections, 96 is a reasonable area if we start to stall, to start considering building long positions in the euro. For the gentleman who is short the euro or the Aussie dollar, maybe he starts to really ratchet down those stop losses. That's how I'm viewing it in terms of the FX market. And typically, when I am doing my dollar index analysis, I'm doing it knowing that that's what I'm going to use as the basis for my trades in the euro, to a lesser degree, of course, in the Aussie and Kiwi dollar, because they don't track the dollar index quite as closely. I'll also look at dollar Canada. Dollar Canada responds very well to the dollar index. So that's how I'm framing it. Again, I have a very narrow focus, as you can tell, but I think that's intentional and it serves me well. I like to look at the same instrument intimately for days on end, hours on end, and you actually do start to get into a rhythm. And that's what I like about keeping my focus to under about 10 securities. That's why I do it. It allows me to kind of get in a rhythm. I'm trying to think something else I'm looking at right here that might be of interest. Yeah, I'll share this one with you. It's a slow mover, but it's a stock a really good friend of mine likes to trade, and that's Bank of America. Again, I'm bullish on the market. Actually, that's not a stop loss there. It's from my time when we were short. So you can just ignore that. Given that I'm bullish on the S&Ps, also looking for the bank sector to probably play catch up by the end of the year. This to me is a very simple correction off of the highs in Bank of America. We stalled right in here last week. I'd suggested to clients that we probably get long down around 29.60 at the time. We're now trading at 30.09. But if I am correct here in my wave count, at minimum, we're going towards 33.55. And again, that's not going to happen today or tomorrow or even next week. But at minimum, based on wave relationships, at minimum, wave 3 will be 100% the length of wave 1 projected from the low of wave 2. And again, with motive wave, I'm able to do these ratio analysis super quickly, super easily. And again, this to me is objective. I'm putting a framework in front of myself saying this would be the first logical upside target. So if you're interested in getting long Bank of America in and around current levels, which I think is still attractive, again, if you want to play it really close, although I don't advise this, maybe your stop's down at 29.27. I would never do a stop like that. That's too close. And if I get nicked out at 29.27, that's not really telling me that I'm wrong. Just telling me that at this time the market's not moving higher. I think in all honesty, if you want a stop loss, it's got to be down around 28.22 or 27.63. That's realistic. But I would probably say you could probably get away with 28.22. So, again, that's a $1.90. That's almost $2 of a stop loss, but you're getting $3.50 plus to the upside, because typically a wave 3 will move about 161.8%. You can see how I can just change these ratios so easily. If Bank of America moves according to the normal ebb and flow of Elliott wave and Fib, it should be going towards $36. So therefore, taking $2 of risk for $5 of payoff, I'll take that trade all day long. So Bank of America is probably one to look at. And I think I got maybe one more question, and that's going to be what I can do here for at least for today. What price needs to be hit for you to take out the bullish S&P view? Good question. Again, I want to be really clear. I'm not out there looking for a problem. And I know that sounds, I'm not trying to be ignorant of the fact that there's always risks in the market. But I know way too many people over the last many, many years who've tried to call a top in this market, and they got nothing to show for it. And that's not to say I'm a permabull, because I believe there's a lot of BS and nonsense going on out there, monetary policy and all the like. But the fact of the matter is, this is a daily chart of the S&Ps. I don't know. Why do you want to be short this? I mean, other than maybe some shorter term trades. I don't know why you'd want to be short this market. So, but to answer the question, I would say maybe anything below here, this previous swing high, maybe if we get back around 28.78 and below, I'd probably start to really look at the market and go, what's going on here? But again, I don't think I'd turn overly bearish either. But that would be a kind of a wake-up call, or what I call a trigger. So, Mike, that's what I got for today. First, again, really appreciate the questions. That's what I like. That keeps me coming back, because it's not just me talking to my computer screen and whether or not anybody's paying attention. So I greatly appreciate all the questions. That's what makes it robust, not only for you, but it makes it robust for me. I learn a few things. I get a sense of what you guys and gals are looking at, and maybe some of the things that you need to see. So I'll get with Mike. I know we're going to get another one of these scheduled and get on a regular schedule. But I greatly appreciate everybody coming by and taking the time out of their day. Mike, is there anything you need to add in here, or are we good for now?
So everybody, we are having a bit of technical difficulties. Dave can't hear me, but this is Dave Floyd of Aspen Trading. Great webinar, a lot of great information, a look at the technical markets, Elliott wave, and really went through some key levels. We're going to have the technical situation sorted out next time so he can actually hear me and I'm not texting him questions. But that is Dave Floyd, Aspen Trading. We'll talk to you guys soon.